topic for today's presentation is creating tax-efficient investment and estate strategies for ultra-high net worth clients through PPLI, otherwise known as private placement life insurance. So the goal of this presentation is to talk about how we can add value to ultra-high net worth clients in a rising interest rate and high tax environment. Again, my name is Rajiv Rebello. I'm an actuary by training. Here are the two companies I mentioned, Colva Services and Colva Capital. So I'm just going to quickly go through over an agenda, what we'll be talking about today and what I'm hoping that you take away from this presentation. So we'll start off just by, again, a brief intro about myself and my companies, as well as the problem. Why are rising interest rates and high taxes a problem for ultra high net worth clients? Obviously, it's a problem for clients, but it's an opportunity for their advisors if they can help address this. And we'll be talking about how advisors can help address this problem by creating essentially portfolio and tax alpha for their clients. So then we'll be diving into exactly what is private placement life insurance and how does it help create both portfolio and tax alpha. We'll then be going over the cost of PPLI versus the tax savings, and then who the ideal PPLI clients are. We'll also be talking about how PPLI is essentially a retirement vehicle for ultra high net worth clients and high net worth individuals as well, similar to a super Roth IRA for clients who would otherwise not be able to contribute to retirement accounts. We'll be talking about liquidity and how to access money in retirement, as well as passing on a wealth tax-free to beneficiaries. We'll then be going on to the risks of PPLI and minimizing the cost, right? Obviously, there's risk-adjusted advantages, but there's also risk involved in it, and how do we manage that and provide the client with the most benefit? Then, given time constraints, we'll go into more of a deep dive for the two parties involved, right? I've separated it in terms of pros and cons for RIAs, so investment professionals, you're creating portfolios for portfolio solutions for clients, as well as on the opposite side of the coin, the state attorneys and CPAs who are really focused on improving tax efficiency, especially if you already use grantor trust type strategies. What are the deficiencies in those strategies and how does PPLI address them? But ideally, you should be thinking about this holistically, right? How can RIAs and estate attorneys and CPAs work together to create a holistic plan for the client that addresses both investment solutions and strategies, as well as estate issues? We'll then be closing, basically talking about other fixed income solutions for high net worth clients who might not qualify for PPLI. So again, as we talked about, I have two companies. Colva Actuarial Services works with, again, high net worth individuals and RIAs on implementing tax efficient life insurance solutions. Often life insurance gets a bad rap because of the high insurance expenses and commissions. And how do we rip those out to really make it a retirement vehicle, a portfolio and investment solution for clients? On the Colva Capital side, it's really focused towards allocating assets towards alternative assets that are uncorrelated, namely life settlements. We won't be diving much into this, but that's essentially, we use PPLI as a vehicle for some of these clients. I'm an actuary by training. I started my career off at New York Life, basically helping to price their UL and VUL policies, and then moved on to working for AIG and their life settlement portfolio, where they had about $18 billion in face amount of policies, 6,000 policies. We're essentially, using it as an investment vehicle, minimizing premiums. And from there, I launched my own practice where we developed software for the life settlement industry. I have a team that runs that software, and then we advise clients allocating to life settlements, as well as kind of what we're doing here today on the RIA and financial planning side. So let's just talk about high level. Well, why is this a problem? Why are rising interest rates and high taxes a problem for ultra high net worth clients, right? The first is that if you're an RIA, allocating clients to low yielding bonds in a rising interest rate environment is not the best recipe, right? So because in a rising interest rate environment, if you have clients specifically who are nearing retirement, who are increasing the bond allocation part of the portfolio, those asset allocations will take a hit in the short term, which essentially, if they're also withdrawing, exposes them to sequence of return risk. So that 60-40 portfolio that works well in a high yield environment doesn't work so well in a rising interest rate environment. And essentially, portfolio managers need to look at other solutions, allocating to alternative assets or other strategies to help offset equity risk. On the estate tax side, right, estate taxes and taxes on the wealthy appear to be going up. The estate tax limits will sunset in 2026, as well as the current administration's agenda to raise taxes on the wealthy, right? Wealth inequality has become a robust issue for those on the left, and that will continue. So how do we, as estate attorneys and and advisors to ultra high net worth clients craft strategies that address these problems, both from a portfolio manager side on the portfolio allocation, as well as on the estate tax side. So given that there's these two issues at hand, namely the portfolio allocation problem as well as the estate tax issue, how do we address a holistic solution? The first is to create portfolio alpha through better risk-adjusted portfolio solutions. So what I mean by this is the typical stock and bond allocation, it doesn't work so well in terms of portfolio diversification in a low yield and rising interest rate environment, right? Because the low yields on bonds are not enough to offset equity risk. On top of that, as we talked about, the rising interest rate means that's a potential for short-term losses that makes it difficult to recover from. On the tax alpha side, we're essentially looking at creating alpha. It's not necessarily portfolio alpha, right? It's a better risk-adjusted return, but you're saving on the taxes so that on an after-tax basis, that's a better holistic portfolio for the client, from both an income tax perspective as well as an estate tax perspective. So ultimately, by creating better risk-adjusted portfolio solutions that are both income and estate tax efficient, RIAs, CPAs, and estate attorneys can both attract and retain ultra-high net worth clients, and essentially separate themselves from their competitors by creating niche solutions that are specifically attracted to the ideal clients that portfolio managers and estate attorneys want to have. So now let's kind of look at what exactly is private placement life insurance and how does it address both these income tax inefficient areas as well as the estate tax inefficient areas. So a simple analogy is that the private placement life insurance is a life insurance vehicle that allows RIAs the ability to manage client assets within a retirement vehicle that protects client assets from income and estate taxes. So the analogy I like to use, it's kind of like a super Roth IRA, right? So most high net worth individuals are phased out from contributing to retirement vehicles. So this is essentially a super Roth IRA that allows ultra high net worth clients the ability to shelter millions of dollars into a tax-free retirement vehicle. And they can use these assets for either saving towards retirement, like a traditional retirement vehicle, or passing it on tax-free to their beneficiaries. Again, much like a Roth IRA. And we'll be diving more into this analogy later on in the presentation. But just a quick flow chart, you have your client. They're essentially using this tax-free wrapper, again, like a retirement vehicle, they're contributing assets to it through an insurance company. The insurance company is then essentially outsourcing the investment management component to the RIA. And the RIA is of a choosing of the client. In traditional life insurance policies, the RIA is separate from the client, and the RIA has cut a deal with the life insurance company to be the outsourced asset manager. In this case, with private placement, the client beforehand chooses the RIA and says, "Hey, this makes sense for me in my estate plan. I want you to manage the strategy." They decide on the strategy together. Once they decide on the strategy, the RIA then implements it. Once in the practice of implementing it, the client has no control over what positions the RIA is essentially managing. And we'll talk about that later on in the presentation. But what this essentially does, it allows a tax-free wrapper, again, similar to the Roth IRA, where the RIA can either invest in income tax inefficient assets or estate tax inefficient assets. Traditionally, so they probably invest in these assets already through a taxable account. It's just essentially creating a vehicle, a tax-free vehicle to better allocate these assets. So if you're familiar with the concept of asset location, right, putting assets in retirement accounts that are better fit, that take advantage of those the tax efficiencies of those retirement accounts, it's the same concept, except you're using a bigger vehicle that allows more flexibility and allows the client to choose the advisor they want managing the assets. If you use a traditional life insurance strategy, then you have to choose an option in an RIA that's separate from the client. So now let's just quickly go over tax inefficient assets versus estate tax inefficient assets. So income tax inefficient assets are assets that are taxed at high ordinary income or short-term capital gains rates and often lack the ability of tax deferral, right? So often that's why you kind of put them in a tax-deferred retirement account, because at least you get the benefit of tax deferral. Estate tax inefficient assets are assets that are expected to experience rapid growth and could subject the client to an estate problem. So I'm just going to go over some quick examples on both sides. So on the income tax inefficient asset side, we have high yield debt, hedge funds, again, or either have high turnover, subject to ordinary income or short-term capital gains, long short strategies, right? Alternative assets that again are subject to ordinary income, which life settlements is one of them. Equity strategies for clients in states with high capital gains tax rates, and I'll touch on this on the next slide. Traditionally we think of equity strategies as tax efficient, but not so much when, again, you're turning over, the portfolio manager is turning over assets a lot, or the client simply lives in a state where capital gains is taxed at a high marginal rate. On the estate tax inefficient asset side, we're really looking at assets that are expected to have rapid growth, right? So which would then pose an estate problem for the client either now or in the future. So you can think of growth stocks or growth positions, privately held positions. I put an example of Peter Thiel's company-owned positions. For those not aware, Peter Thiel bought his PayPal owner shares within a Roth IRA using, I think, his $2,000 contribution. Obviously, that's now worth $5 billion. So you can do things like that within a PPLI. Let me just go back real quick. You can obviously put assets like that within, a retirement account if you're able to, or you can do that through PPLI as well. You can kind of take positions, individual, privately, closely held positions like that in PPLI. So now just quickly, we talked about tax inefficient assets, equity strategies that are taxed that have high tax rates on capital gains in certain states, California being one of them. The top marginal bracket on capital gains rates is 13.3%. Here are some other states. So, since we're in California, if you're managing clients who are, in the top tax bracket, the equity strategy no longer become tax efficient, right? Even long-term capital gains are taxed at high rates, as we'll see in a second. So now let's just kind of talk about the cost, the tax savings versus the cost, right? So that's really the benefit here is it's the setup, the ongoing cost of a PPLI strategy versus, the taxes that the client would otherwise be exposed to if they were investing in this through a taxable account. So let's just look at, we're just focusing on the top rates, top marginal tax rates. So ordinary income, we have top federal tax rate of 37%, top CA state income tax rate, 13.3%. We just saw that. The Medicare surcharge, on this side, there's no plan costs or insurance expenses, but when you add all that up, you're at 54.1%. Long-term capital gains, like we talked about, 20%, 13.3%, the Medicare surcharge. So 37.1%, simply because California is hitting you with this high tax rate. So on the state tax side, it's 40%. Again, there's no other expenses, but these are essentially the taxes that the client would be exposed to for your ultra high net worth client. Whereas PPLI is not charging any taxes, but there's expenses involved, and that's about 5 to 10%. So this is essentially the opportunity here, right? Between these tax rates that the clients would otherwise be exposed to versus the cost of the insurance expense. So by creating kind of better risk-adjusted portfolio solutions that are both income and estate tax efficient, RIAs, like we talked about, CPAs and state attorneys, can kind of create better solutions for their client that's holistic, right? It's not just addressing one part of the solution, income taxes or estate taxes. It's combining a solution. It's allowing the clients the ability to choose their partners, choose the RIAs they're working with, and choose the estate, and they collectively come up with a solution.
Hey, Rajiv, just a quick question.
Yeah.
How do you define ultra high net worth so we can get a kind of a perspective of where this would apply to or not? Thank you.
Yeah, it's a good question. So traditionally, let's separate it. For me personally, it's 10 million and above. For the purposes of PPLI, they have to be a qualified purchaser, which means 5 million in assets and above.
Thank you.
Okay. So now kind of let's go back to our analogy of a super Roth IRA. We're going to be talking about liquidity and retirement and estate taxes. So please, this gets a little bit complicated here. So if you have questions, just stop me. I tend to go fast sometimes. So let's compare it to a Roth IRA. So like a Roth IRA, you can take out principals, your principal that you put into it at any time with no penalty. But if you have gains on it, again, if you're paying taxes on the gains, right? Ordinary income taxes on the gains. If you take this out early, right? The Roth IRA charges a 10% penalty on taking out gains before 5 years or 59.5. So now let's compare that on taking money out from a Roth IRA early versus taking out money from a PPLI vehicle early, right? So PPLI, you can also take out your assets at any time. There's no penalty. Obviously, you can take out the principal anytime, just like a Roth IRA. There's no penalty on the gains, so you're not paying that 10% penalty for taking it out early before 59.5. And there's no surrender charges. However, what you are paying are high insurance expenses. So it's not exactly a a risk-free opportunity. We'll see this in the graph below, is that because you're paying for it in the sense of expenses that are high in the early years. On top of that, what we'll be talking about, one of the advantages of PPLI is it allows clients the ability to pull out 90% of the principal and gains via tax-free loans. So ultimately, what you want to do is you don't want to take out money from the vehicle just by liquidating it, and because then you'd have to pay income taxes on the gains, right? What you want to do is you want to pull out 90% of the principal and gains tax-free via a loan, and we'll show that down below in a second. But the overall point is that you have to invest in the vehicle for at least 7 to 10 years. So just like a retirement account, you need that time for sorry, the interest just to compound, right? In a retirement account. With a PPLI vehicle, you need both the compounding as well as the insurance expenses then become less over time. So just a quick graph to kind of illustrate these points. I'm going to show imagine you're investing in an asset that's making a gross return of 8%, but it's tax inefficient and you're doing it in a taxable account. Here's the IRR. It's about 3.7. So you're seeing that it's straight every year. So if you take it out, in year 1 versus year 30, you're getting this, 3.7, right? So it's straight. Versus the PPLI, like we talked about, there's no 10% penalty, there's no surrender charges, you're taking it out. But what's happening in the early years, you're not getting the 3.7 because you're paying insurance expenses. So depending on when you take it out, you can see if you take it out 5 years, it's getting closer to that 3.7. But the best way to excessively liquidate is to keep it in the vehicle and take out a tax-free loan. You can see that the IRR jumps dramatically if you take out a tax-free loan in year 11. And from there, you see it's it's a little south of 6%. Again, the longer you keep assets in the vehicle, the better your return is. So if you just keep the assets in the vehicle 10 extra years and take out a tax-free loan in year 21, you're getting about an extra 50 basis points. The point being is that there's ways to liquidate without actually taking it out and then paying taxes on the gains. It's obviously the whole point of the vehicle, but it does provide liquidity. So you just have to use liquidity efficiently, which is through the tax-free loan feature. But ultimately, for clients, like we talked about, they have to be willing to be in the vehicle for 7 to 10 years. And obviously, the liquidation, if they want to liquidate for retirement, they need to be able to or be willing to use the tax-free loan feature. So the point being, the longer the clients keep the money in the PPLI vehicle, the better it is for them. But there is liquidity available. So I'm going to quickly go over the slide. I'm not going to spend too much time on it, but the idea is, that's often asked, well, Rajiv, why is PPLI a better solution than traditional UL? I can get a traditional UL and VUL policies without going through this. And the concept here is that PPLI rips out the majority of the commissions and insurance expenses. And it really focuses on RIAs as the distribution channel, as opposed to the insurance agent who's getting highly compensated. There's a lower cost of insurance since clients are wealthy. The insurance company knows that. They have better access to healthcare. So if you actually look at the cost of insurance charges, they're significantly less in a PPLI vehicle. It also allows RIAs to create their own investment strategies and charge fees from within the vehicle. So, instead of charging your fee from an after-tax account, you're charging your fee from within the vehicle. So if you already manage retirement accounts, this is again a strategy, because if you're managing it, let's say for a traditional IRA, that's reducing the taxable gain, right? There's no surrender charges. You're able to pull out 90% of the principal and gains through withdrawals and tax-free loans. And there's wash loan features. So one of the real benefits here of loans is that yes, they're charging you maybe 2% interest on your borrowing money, but they're crediting that 2% interest in the policy. So just real quick on the expenses, I don't want to spend too much time on it, just to get across the high level point that expenses in a traditional policy are high and expenses in a PPLI policy are low. So when you talk about upfront commission, for a traditional, let's say a $9 million VUL policy, you're talking about 80% to 100% of the first year premium. Obviously that's a lot. And so us actuaries, if we give this amount to the agent upfront, the insurance company is operating at a loss. We have to hit it with high charges at the back end. We'll talk about that in a second. Whereas on a PPLI policy, you're looking at about 0.15, 15 to 20 basis points a year. So in the first year and then ongoing. So it's more aligned with the long-term nature of the product, as opposed to a huge drag at the beginning, right? There's a trail commission for traditional policies, about 2 to 3%. It's not much, but it's still significantly more than what it is on the PPLI side. The premium loads are also higher, right? If we're giving the agent so much, we have to implement a high premium loads, whereas they're fairly low on the PPLI side. Is administration charges, M&E charges. Again, we talked about cost of insurance charges, and then obviously surrender charge. We have to hit the client with a a large surrender charge. So what most people don't realize, about 50% of people will cancel their permanent policy, get hit with a huge surrender charge, and walk away with very, very little. That's why it can be a horrible investment if not used properly and sold to the wrong channels. There's no surrender charges on PPLI like we talked about, so it's easier. If you want to exit, you can. Obviously, the longer you keep it in the vehicle, the better it is for you. And the key thing here, what I want to get across, is that there's an outside portfolio manager, right, with the VUL policy. Whereas with PPLI, you're choosing the RIA that you want to work with, who crafts a strategy specific to your needs. So it's not a one-size-fits-all solution. It's you're working with your RIA, and this is where the real added value comes to both the RIA and the client. And the RIA is earning his or her fees on these assets. Whereas here, even if this VUL policy is better for the client, the RIA is essentially saying, hey, use this vehicle and take away money that I would otherwise manage, right? So the investment options are limited on the VUL side. They're mainly tax efficient anyway. So what's the point of using the vehicle? Whereas on PPLI, you can use tax inefficient and alternative strategies.
Hey, Rajiv, just going back to that screen, there was a question on the range of the premium loads from 8 to 18%. What counts for the variability? It's pretty wide.
It depends on the carrier. It's really on the carrier. The carrier chooses depending on how they want to structure the product. And that depends on markets. So a carrier might, say like, look, we're going to have high premiums in the early years and low in the later years. We want it high in every year. So it really depends on the design and what the carrier is looking for.
Okay. And I know you might be getting into this, but just a quick question. Can real estate be an investment option?
Yeah, 100%. Yeah, for PPLI, you can use a whole variety of things. You can use, we'll talk about that in a second. You can go into Bitcoin and all that stuff. You have to be careful. Some insurance carriers won't accept it, but almost anything you can think of, you can manage from within the policy.
Thanks.
So let's just quickly go. Let's see, I'm doing on time. Okay. What are the problems? How does PPLI solve these investment and estate problems for ultra high net worth clients? So for the RIA side, bond portfolios are portfolio diversification tools in the current environment. They're low yielding, right? So on the basis, they're not enough to offset equity risk, right? On top of that, interest rate risk, as interest rates rise, which the Fed has made clear that they're going to raise interest rates to fight off inflation, that's going to pose immediate losses, right? And so if you're allocating towards bonds heavily for clients nearing retirement is a way to protect against sequence of return risk, that's going to be an issue, right? And they're tax inefficient. So the gains that are coming off the bond portfolio, those are all, essentially ordinary income, right? So the after-tax portfolio diversification for bonds in this environment it's almost nil. PPLI allows RIAs to craft a better solution. So PPLI allows RIAs to say, like, look, in place of bonds, what other assets can I use? Can I use uncorrelated assets? Can I use alternatives? Can I use long short strategies that I otherwise wouldn't be open to because of the risk, right? There's more risk in these strategies, but essentially what PPLI says, like, yes, there's more risk in the investment side, but I'm saving you on the taxes. So on a risk adjusted basis, it's better off. So it's forcing clients or RIAs to think about portfolio allocation differently and more efficiently, right, than just a traditional stock and bond portfolio. So especially for RIAs who want to create a niche and say, look, this is how we separate ourselves from other RIAs by using more kind of creative solutions, this is what PPLI addresses. So from both a functional math standpoint as well as a marketing standpoint, that's what PPLI allows for RIAs. On the state attorney CPAs, we'll talk about in a second, grantor trusts are tax inefficient to the grantor and at legislative risk. So what that means is if you're using grantor trust, it's great because the assets are outside of the state, but all those gains in the grantor trust are then taxable to the grantor. So if the grantor has given all his assets, his or her assets to the trust, that's earning revenue, but they no longer have income to pay the taxes that are due on those gains, right? So they can borrow from the grantor trust, but it poses issues. On top of that, on the legislative risk, so if you were following the kind of Build Better Act original proposals, the grantor trust, these kind of discounted valuation, they were all, the administration wanted to cut the use of all of them. Whereas the PPLI, the non-grantor trust, that was still, again, the lobbyists apparently were stronger on the insurance side than they were on the estate side. But grantor trusts don't qualify for step up in basis, right? So you need to use swap powers, right? If you're using IDGITs, you need to use swap powers and you need to time it, right? You need to use the swap before the client dies, right? So otherwise the assets in the estate don't qualify for step up in basis. It's a huge issue. On top of that, again, step up in basis, the original proposal was they were going to cut this. They were going to, reduce step up in basis, but then there was a whole farming issue, and that was eventually removed. And ultimately, none of this was enacted. None of this, the grantor trusts are still effective today as they were. That being said, the left has made it clear that they're going after these type of solutions. So what the PPLI does, it allows tax-free growth. Again, you're going to grandfather it, it's going to be a solution that allows more flexibility, as well as the tax-free growth than kind of current legislative risk of grantor trust type strategies. So now let's kind of quickly go over who are the best clients for a PPLI solution. First, like we talked about, they have to be qualified purchasers, right? So 5 million plus net worth. Actually, it's investable assets, but they have to invest 1 million to 2 million within the structure within 4 years. So if you think it's 1 million, that's like an average of 250K each year over 4 years. 2 million is about 500K. Obviously, you can front load that, you can back load it, you can dump money in however you choose, but those are the general requirements. They should have an estate tax issue now or in the future. That's kind of why you're looking at this, because you can use essentially the exemption now, especially if you're your clients who haven't used the exemption, and have all the asset growth be, again, outside of the estate and tax-free, right? Not taxable to the grantor, but completely tax-free. The client is working with an RIA, and they both want greater access to tax-efficient alternative assets. So like we talked about, maybe they didn't consider alternative assets in the past, but now under this current environment, they're seeing the advantage of doing so. And they want greater access to that. And the PPLI vehicle allows this ability. They should be between the ages of 40 to 65. And you might be asking, well, why? And I'll explain that. Similar to a retirement vehicle, how you need time for the compounding growth. For PPLI, you need both of that. You need both the time for growth, as well as the ability to dump in assets into the vehicle. If you're too young, you're limited into how much you can dump into the vehicle. And if you're too old, what happens is the insurance expenses are high. So then there's a high barrier of entry because you have to, counter the insurance expenses. So ideally, you're within the ages of 40 to 65. So if you have clients who meet these criteria and who are interested in who have income tax issues or state tax issues or potential, this is a vehicle that would address some of these solutions, or some of these problems rather. So now, I'm going to spend a little bit of time on this as well. Risks, right? So nothing is, there's no free lunch. So where there's opportunity, there's also risk. So we're going to talk about the risks here and how to mitigate it, and more importantly, the importance of mitigating insurance risk, which is neglected in insurance policies, and why insurance gets a bad rep. And in order to create that risk-adjusted return, you have to manage the risk, right? So first, liquidity risk. We talked about you can exit early, but you're going to pay ordinary income taxes on the gains and high insurance expenses. So you don't want to enter it and then exit it within 5 years, right? Because look, you're gonna get hit with high insurance expenses, and any gains you're paying ordinary income taxes anyway. So what's the point? So they have to have a long horizon, and you have to be okay with that. A long horizon meaning at least 7 to 10 years. Understanding that it's better to take out the 90% principal and gains through tax-free loans after 10 years. So this is the best vehicle. You have to understand the advantage of essentially, refinancing. You're taking out principal and gains through the tax-free loans. That it's a better option than just liquidating completely. Insurance risk, and this is the key thing that is often neglected. With retirement planning, you're focusing just on investment growth and time horizon, right? You need the the compounding of interest, the tax deferred or tax-free growth. With insurance policies, you're combining investment and insurance risk. So if the client doesn't fund the policy properly, it essentially increases the risk that they're opposed to, and increases the insurance charges. On the contrary, the better they fund the vehicle, the lower the insurance charges are. So they're combined. If the client doesn't max fund the policy, they're increasing the insurance risk. So whereas in a retirement account, if they just don't fund, save as much for retirement, that simply means there's less time for compounding. Whereas here, there's more expenses if they don't fund it. So it's important that clients and advisors understand it's very important, a lot more so than just a retirement vehicle, to make sure that the client is actively contributing to this vehicle, right? And you're following through with the investment plan. Otherwise, the insurance charges will exponentially increase. And that's what happens when insurance gets a bad rap, is the client didn't fund it properly. You must respond proactively if the investment strategy has negative returns. Similar to not funding the properly policy, let's say the strategy you're invested in just the S&P 500, right? And that takes a large hit. You have to manage the insurance risk in saying like, look, I have a, $10 million policy, but I used to have 4 million in the account. Now there's only 2 million. What do I do? How do I minimize the insurance risk? You have to look at cutting the death benefit, taking out a loan, other things to reduce the insurance risk. And this has to be proactively managed. So just like you're rebalancing portfolios on the investment side, on the insurance side, if you have negative returns, you have to manage the insurance risk by taking these strategies. So this is almost always neglected on the insurance side. And if you're using this strategy or any insurance strategy, you need to be aware of that, and manage that proactively. Premium load expenses. We talked about different states have different premium loads, 0.8 basis points to 3.5%. So if you're setting up a trust to essentially manage this, it's important to look at states that have low premium load states. So even though your client might live in California, you should look at other states in which the premium load taxes are different, especially if they want to dump in a lot of money. I'd recommend South Dakota because that's 2.5% up to $100,000 premium in a year, and then only 8 basis points afterwards. So if you're thinking about that $2 million requirement, it's actually better if you front load that. You pay $2 million all in year one, because that way the first 100K is going to be subject to 2.5%, but the remaining 1.9 million is only getting hit with 8 basis points. So again, setting up in trusts in low premium load states like South Dakota is important, as well as the funding strategy, something to consider. And again, the client doesn't have to live there. The trust does have to be set up, and the trustee of that trust has to be in South Dakota.
Hey, Rajiv, just so that we all know, what is the premium load for California?
I think it's like 3 point something percent, 3.3, 3.5, something like that.
On the full amount, there's no step.
On the full amount, there's no cool little like up to 100K. No, it's on the full amount.
Thank you.
Offshore versus onshore. So we were talking about earlier about investment flexibility, and that's where the offshore versus onshore. There's onshore companies that deal with PPLI. There's offshore. So the key differences are that onshore has lower COI expenses, M&E charges, and better loan provision. So you can take out loans a lot easier with onshore companies. It's very strict and kind of bureaucratic, but what you're giving up for that is investment flexibility. So if you want to invest in more kind of exotic strategies, whether it's Bitcoin, alternative assets, kind of more exotic strategies, you're not going to be able to do that onshore because it's very strict on how they do it. Now offshore, you can do this. So they have kind of lower premium load expenses and more flexibility with the insurance expenses. Sorry, more flexibility with the investment options. But you're paying for this flexibility through higher COI expenses, M&E expenses, higher loan costs. So there's give and take depending on how you're coming at it. If you're an estate attorney and CPA, you're like, I just want the best product, right? I want the in which case you want to go onshore. If you're coming at it from an investment advisor who wants to attract clients through kind of alternative strategies, you're probably looking at going offshore. Other things that could be considered is that not all offshore companies are the same. Obviously, if you have any clients who've invested in through the Cayman Islands, that there's loopholes there for a reason, but some of these companies can skirt the intent of the law. They might abide by the letter of the law, but the intent of the law, they're kind of circumventing, and that's why they're offshore. So when you look at things like discounted valuation on in-kind securities, obviously, if you're working with IDGITs, you use this already. You transfer assets, this is publicly held securities to the trust at discounted valuation. So you can do the same thing with PPLI. Obviously, this is going to be heavily scrutinized. So just the point being is that if you choose to go onshore, make sure you're doing diligence on the offshore company. You're working with an estate attorney on these issues, just to make sure that it's reputable and everything's okay, and you're okay with any kind of legislative changes after the fact, which would also also be affected again. If you're using IDGIT and grantor trust strategies currently, it would be the same issue. They're trying to circumvent essentially the intent of the law through the tax savings. If you just want a quick referral on companies to look at, I'd strongly recommend onshore. Prudential has some of the lowest insurance expenses I've seen. The best offshore company is Lombard's survivorship product. Again, low COI expenses, a lot of investment flexibility, really a lot better on the bureaucracy side of it in terms of actually implementing strategy and work with. Lombard is a lot easier than Prudential. So again, just for you to do your own research. See how we're doing on time. So again, what are the rules for PPLI investments? So there's diversification rules. That means you can't just invest in, let's say you want to do a real estate property, you can't just invest in one property, right? Because that's exposing the client to risk. So they have to be essentially invested in a diverse array of assets, and that diversification is defined by these rules. For one asset, it can be no more than 55% of the investment. 2 assets can be no more than 70%. 3 assets can be no more than 80%. 4 assets can be no more than 90%. So essentially what PPLI is saying is that the client must be invested in at least 5 different assets, and you cannot exceed these limitations. On top of that, the client has no control, and this is a key thing. The client can say, hey, portfolio manager, I want you to buy this property and that property. No, they can do that with a taxable account, but within PPLI, the RIA gets to make all the decisions. They can create the strategy together beforehand. Like, okay, they both agree on a real estate strategy, but after it's implemented, the client has absolutely no say. And it's a key thing. So sometimes clients can think, and obviously they kind of circumvent this with grantor trust strategies anyways, but it's a key thing on PPLI that they have no control. And you need to abide by that. Otherwise you risk putting the tax advantage of this all at risk. So I want to quickly now with the time left that we have about 20 minutes, spend a little bit talking about kind of doing a deep dive for RIAs. Just in terms of looking at the kind of portfolio diversification and the importance of using, other strategies beyond bonds to provide diversification and creating kind of tax benefits. So just a quick analogy, if we make our current assumptions on what stocks and bonds are earning, again, going forward, I don't know if this is applicable, but let's just assume stock, the equities are at 10%, bonds are at 2%. Again, the highest marginal tax rate, long-term capital gains, not so tax efficient for Californians. But your after-tax return is about 6%, 6.3%, whereas bonds, you're looking at 2%, high marginal tax rate. So the after-tax return is 0.92%. And that's why it's not really providing, the diversification in this environment that it was previously in a higher yield environment. And we haven't even talked about the interest rate risk. So like we talked about, low yielding, highly tax inefficient bonds add little value to portfolio solutions, even when stock valuations and PE ratios are at all-time highs, right? So now if you take it a step further and say, well, how does this affect us on an after-tax, after advisory fee basis? On the equity side of the portfolio, you have your after-tax return, you're paying a wealth manager fee, that wealth manager is allocating to various funds, you have a platform fee and inflation. So you're at, once you consider all the effects of this, the after-tax, after inflation, after cost, the value of bonds in this type of environment is not providing a positive return, right? And that's why there's an opportunity to use other uncorrelated assets, other alternative asset strategies, that RIAs otherwise would not be comfortable allocating to because of the risk. But here in this environment, that risk can be more than mitigated on the tax side, and that's where PPLI kind of comes in. Interest rate risk, quickly, most of you are familiar with this, but obviously, longer term bonds have higher interest rate risks. And so what I've quickly done is shown what happens if you're allocated to bonds of, the maturity is 10 years, 20 years, or 30 years, and interest rates rise from 1%, let's say from 2% to 3%. Obviously, if it's a 10-year bond, you're looking at an 8.5% loss, whereas it's 30, it's almost minus 20. You're going to take a 20% loss. So you would say, well, okay, fine, but let's say interest rates drop, but then I'm gonna invest in higher yielding bonds. And you're right, you are investing in higher yielding bonds, but if it's a 10-year bond, it's going to take you 4 years to recover. If it's a 20-year bond, 6, and it's 30, it's 8. On top of that, just to get to the original 2% yield that your client thought he or she was getting, is going to take 10, 17, and 23 years. So the point being is that a 1% increase in interest rates can take years to recover from. And this can be devastating if your clients are near retirement and are taking withdrawals at the same time. So they're taking withdrawals from their portfolio while their bond part of their allocation is taking heavy hits, that sequence of return risk, right? So long-term bonds can have higher interest rates, but you're also exposed to more losses. So what do you do? Short-term bonds or long-term bonds? You're just like, okay, if I give up on long-term bonds, I'm allocating short-term bonds, but I'm not getting much on the yield. I'm protecting from interest rate risk, but I'm not getting much yield, right? So short-term and long-term bonds, they're posing problems either on the low yield side or on the interest rate risk side. And PPLI allows the ability to invest in otherwise tax inefficient assets with higher returns. Now, another thing, we'll talk about at the end, other insurance products, whole life, no commission annuities, allow RIAs and clients the ability to invest in longer term bonds without interest rate risk. So if this is a concern to you and you don't want the PPLI solution, or you want to stick with, you're comfortable with bonds, you can invest in bonds through other insurance products like whole life, and protect clients against interest rate risk. In exchange, the insurance company is earning a spread, right? So you're not going to get the full whole long-term bond interest rate, but they're going to earn a spread, but you're protecting clients from interest rate risk. We'll talk about that at the end. So for RIAs, the point B here being is that this is an opportunity in this environment to stray away from the 60-40 portfolio and invest in alternative assets. And you are taking more risk, right, by investing in alternative assets, but you're sheltering it within a tax-free vehicle, right? So that's where you're providing greater risk-adjusted return. I also wanted to quickly talk about the advantage of charging your fee, right? Let's say you're a portfolio manager, charging your fee from within the PPLI vehicle versus from how you're traditionally doing in a taxable account, which is your after-tax account. So let's just look on your after-tax basis here. Let's say the gross yield is 8%. You're not charging your fee pre-tax. That means the whole taxable gain is 8%. Let's say the tax rate on that taxable yield is 50%. That means after taxes, the client's getting only 4% of this 8%. You're then charging your 1% fee. So then the after-tax, after advisory fee bond yield, I'm using bonds as an example, is just 3%. Whereas so you take that same asset and you decide you're able to charge it within a retirement account. Let's say those same bonds are in a traditional IRA or a PPLI vehicle. So then what you're doing is you're reducing the taxable gain. So it's 8%, you're charging your 1% fee. So the taxable gain is now 7. That's 50% of the 7 is lost. Now you're down to 3.5, but there's no after-tax fee. So the client's getting 50 basis points simply by using a better asset allocation strategy, right? You're placing bonds, tax inefficient bonds within a tax advantage vehicle, whether it's a retirement account or PPLI vehicle, it's the same difference. But the point being is that it's better for the client on an after-tax, after-fee basis by using kind of asset location strategies. So that's one of the key things I'd like to RIAs think about, like how do you get ultra high net worth clients into these vehicles if they're phased out from contributing to retirement vehicles. So just on the estate attorney side, PPLI allows better generational wealth strategies than current grantor trust strategies. So if you're an estate attorney or use these IJITs or GRATs, like we talked about, GRATs are taxable to the grantor, while PPLI strategies are tax-free. So if your client is using a grantor trust strategy, is putting a lot of their wealth into this GRAT strategy, the issue is that all those gains are then taxable. They essentially need income just to pay the taxes, and that poses a problem. Whereas in PPLI, all that income is tax-free. It's you don't have to worry about step up in basis. It's tax-free to the grantor and the beneficiary. Like we talked about from on the legislative standpoint, right? The left's agenda is clear that income inequality is a problem for society, and they went after it hard with their initial proposals. They wanted to remove all the grantor trust benefits for GRATs and IJITs. They wanted to remove step up in basis, increase payroll taxes on individuals, increase capital gains rates, phase out the QBI deduction, again, reduce the estate tax exemption limit immediately instead of 2026, increase the estate tax rate, limit 1031 exchanges, and eliminate the backdoor Roth IRA. Obviously, none of this passed, but the agenda is clear, right? On the left, as income inequality becomes a bigger and bigger issue. So PPLI allows a vehicle by which to protect clients from all of this. If you're on the opposite side of the coin, on the fiscally conservative side, it's more a question of the rising debt as a percentage of GDP, right? So obviously with the COVID passing, it jumped up tremendously, but debt as a percentage of GDP is increasingly high. So in terms of compromise, it's unlikely that the right will concede on income tax, raising marginal income tax rates, because they believe that that's crucial to encouraging investment in the economy, right? By keeping low marginal tax rate. That being said, estate tax rates are an area where they'd be more open to compromising. So if you're an estate attorney looking at this, the reduction in estate tax limits in 2026 is something to be concerned about. You might also be pointing out that the low interest rate environment means that the cost of servicing the debt is low. So the cost of servicing the debt relative to GDP is low, and that is correct. But obviously, if you're making the argument that one of the reasons GDP has grown is because the low interest rates has facilitated investment into the economy, then when rising interest rates happen, then the opposite will occur, right? And then the debt becomes a bigger and bigger problem. So from a fiscally conservative standpoint, it needs to be more concerned with estate tax risk and the ability for generational wealth transfer in the future, which won't be as available as it is now, right? So for estate attorneys and CPAs, PPLI allows more tax efficient structuring than current grantor trust strategies. PPLI provides built-in grandfather protection against tax increases and protection from step-up in basis. So even in the future, if they reduce step-up in basis, anything in the PPLI vehicle will be outside of that and not subject to this. And more importantly, PPLI allows estate attorneys, CPAs to work with RIAs to develop more holistic estate and investment strategies. So it's a more holistic plan geared towards the ideal clients that estate attorneys and RIAs want. It allows a referral mechanism where you're finding RIAs that you can work with to implement. They'll hopefully refer their clients to you if you're the estate attorney, and vice versa. It creates more comprehensive plan and a way to not just on a math basis on tech, but also as a networking opportunity as well to grow your business and attract the ultra high net worth clients that most advisors would love to have. So now I just want to conclude. We talked about how PPLI is only available to kind of qualified purchasers. So if you're not a qualified purchaser, you can still use life insurance as a vehicle to accomplish a lot of what we're talking about today. Obviously not as efficiently, right? Because with traditional insurance products, the expenses are going to be higher. That being said, it is going to be a lot better than the current solutions of investing, in fixed income and taxable accounts. So I just want to quickly go over the opportunities here for insurance for high net worth individuals, again, who wouldn't qualify for PPLI, and how they address the kind of the fixed income problem of client portfolios. So first, we'll talk about no commission annuities. Hopefully, when I send this to you, they'll have links here. If you want to do more research, you should just be able to click on the link, and it'll take you to a whole article. That'll be similar to this presentation on this, but specific to each of these vehicles. So no commission annuities. It's tax-deferred long-term bonds without interest rate risk. We talked about how insurance companies can, because they have a lot of assets and a bigger time horizon, can allow you the ability to invest in long-term bonds without interest rate risk. Obviously, they're taking a spread. But that's better than investing in short-term bonds. And the retirement account simulators, traditional IRA, the expected rate of return is about 2.25 to 4%, tax deferred, minimum holding period 5 to 7 years. Whole life insurance are essentially you're investing in tax-free long-term bonds, again, without interest rate risks, and they're giving you dividends, right? So as insurance companies profitable from this, they're essentially issuing you dividends. It's again similar to a Roth IRA. Expected returns are about 4 to 4.5% structured properly. Again, your holding period is 15 to 20 years, so it's significantly longer. Indexed universal life, what you're doing is instead of investing in bonds, you're investing, you're taking equity risk, but it's coming with a cap and a floor. So what you're doing is you're getting the higher returns of equity without the volatility. So it's again similar to a Roth IRA, and all of that's tax-free, right? So you're increasing the equity allocation of the portfolio, but without the volatility. You're looking at 5 to 7% with IUL, again, 20-year holding period. Private placement life insurance, we talked about already through Roth IRA. Life settlements, you're not just using it as a vehicle, you're using life insurance as the underlying assets. It's uncorrelated to assets in place of long-term bonds because the risk is dependent on mortality, which is not independent of interest rate risk or market risk. When people die is independent of that. There's no retirement account similarity, but with PPLI, it's tax-free. That's kind of, again, when we talked about allocating to uncorrelated assets. So it's about 9 to 11% taxable, 9 to 11% tax-free with PPLI. Again, you're taking that from the bond portfolio. Your holding period is about 10 years. So these are the variety of ways that we work with RIAs, CPAs, and estate attorneys to kind of craft better strategies, especially in this environment, and how you can use life insurance properly, right? Not selling the high commission, high expense products, but using it as an asset location vehicle, right? The same way you encourage clients to utilize their tax deferred retirement accounts. But that's essentially, that covers our presentation here today. Hopefully leave some time for some questions. If you do want to reach out, feel free to drop me an email, especially if you want to keep in touch and learn more about these products and what we're doing in the space and how we're working with kind of advisors who are looking really to create a niche within this ultra high net worth client market, as well as just trying to address the fixed income part of the client's portfolio.